All right, Christian, appreciate you coming in, man.
You bet. You bet.
Christian, why don't you tell us a little bit about you, kind of what you do right now, and maybe how you got started in that?
It's a pretty big question, but yeah, I'll give it a whirl. So, what I do, trader, obviously trading the markets, mostly options, some stocks as well, ETFs from time to time, but usually that's options on the ETFs.
Exchange traded funds.
Hmm.
I'm sure we got a lot of people who don't follow this stuff, and we'll dive
That's
into a
right.
bunch of kind of the descriptions here.
Yeah, I'll think about the all the different.
Yeah, all the jargon.
Yeah. So, but I guess what you could say my uh, profession now as a coach. I mean, I teach. Been teaching for around 16 years. Students how to trade, invest, usually options, but I have a lot of students I've worked with that have looked for longer term. So I want to control my portfolio. I just want to manage my positions. I think I can do better than my advisor, things like that. So that I've been doing for 16 years to the tune of about 5,000 students in over 30 countries. Um, so a lot of the coaching, but a lot of trade services, which obviously we're talking about, where that is for those that don't know, trade alert service would be where I send you the entry and I send you the exit. So now my skill set is in what we call technical analysis. So for your listeners, what the public tends to associate with markets is fundamentals. So how good the company is, products, growth, earnings. Technical analysts, such as myself, subscribe to the idea that everything that is known by the market. So in other words, it's discounted into price. So there's nothing that we in the public can learn from what we read that price couldn't already tell us. So my job as a technical analyst or a CMT, chartered market technician, is to read that price action, no matter what the security is. So it could be the S&P, could be an individual stock like Apple, and it could be an ETF. What do I think of steel or gold? So my job is to say, all right, with everything that we know in the way of price, momentum, sentiment, breadth, what does this security tell us it's likely to do, or odds, favor? And then it's all about evaluating risk and reward and things of that nature. So it seems weird to the layperson. It may have when you and I first started talking as well. But what I do, I teach to ignore all the things that you traditionally think. So don't worry, what the company does or does not do. You don't actually, and I know this flies in the face of Warren Buffett, but you don't actually make any money off what Tesla, the company, does. You make money off what the stock does. So again, as technical analysts, we encourage traders or investors to focus on the stock, not necessarily the company.
Is it fair to say that technical analysis is more short to medium term strategy than it is like long term? Right.
I would say that is the that is the meat of the field. When you think of traders, you think of technical analysis. Traders that might be trying to day trade, traders that might be trying to swing trade or short term trade. Fundamentals aren't really a factor, right? Stocks are going to go up and down every day for a week, 2 weeks, void of any information about the company. So yes, I would say that typically you would associate it with it. However, my knowledge base takes it a step further. So there are, for example, on the calls that you've heard me do over the past week, we talk about big breakdowns, big breakout. These are things that you might want to be in for years. That this is a bigger. We refer to it in technical analysis as fractal in nature. So as a trader, I might be looking for a very short-term breakout. As an investor, I'm looking for that same breakout, but bigger time scale, bigger price scale, things of that nature. But I would say you're correct that the lay understanding is for traders.
Yeah. So I mean, maybe just explain to me what it even means to be a trader, right? So you run these trade services where you're feeding people different trades, and I know you have skin in the game. You're actively doing these trades also. So it's not like, hey, you spend your money on this trade, but I'm sitting on the sideline. So I know you've been actively trading for a long period of time. You have a successful track record of doing so. I think people have knowledge of what a financial advisor does. Maybe a lot of people listening probably have a financial advisor. They have a friend who's a financial advisor. And then maybe have like this funny opinion of like what a trader is. They have just like 6 monitors. They're just looking at screens, charts, and this and that and the third, and they're getting in and out of position like 10 minutes later. So what does it actually mean to be a trader? Can you explain and maybe even just talk me through like a day in the life of a trader?
Uh,
Wake up at 10 o'clock. You already
yeah.
missed the opening.
Yeah. You're up at 3 looking at the futures.
Yeah.
What's happening in China? Please, God, please rally. Um, so, it reminds me of, when you think of, I don't know if you remember these books. It was a long time ago, but The Millionaire Next Door
Oh, yeah.
and The Millionaire
Yeah,
Mind.
read
right?
that one. Loved The Millionaire Next Door.
So you may remember or recall there's the perception of a millionaire, then there's the reality
Yeah.
of a millionaire. The reality of a millionaire tends to drive a late model pickup truck or a Toyota. The average millionaire operates a quote boring business, right? It's not what we see, and not what we are marketed to believe success is, right? So trading is very similar. What we are marketed to believe. Now, I'm not saying there aren't those traders out there that don't work at trade desks that have multiple screens and all that, but when we
Just
think
like
of
there's millionaires who do drive a
yes,
Lamborghini and have a
exactly.
Rolex.
It's
They're
not that
just
they're not
the
there.
outlier.
But the average trader, so if we talk about the average trader, us in the public, a retail trader doing this, not somebody hired by a prop desk or Goldman or something like that. So let's talk about them. Typically what that is, it's not all the glitters and gold, right? It's usually one monitor. Most of the trading actions that I take are on my phone. So the alerts that you see me send out, a lot of times it's on my phone. Now, in all fairness, let's take a step back. I know the markets and the stocks that I'm putting trades on forwards and backwards. So I don't really need to see anything to know what we were looking for, right? So you know the jargon, hey, if this breaks through 150, we want to get in. I don't need to be in front of a computer. So your average trader, typically is one monitor, maybe their phone. I have like 2 monitors when I'm sitting there. One is so I can send emails while I'm watching on the screen. So you can see that in my calls. I'm talking about what I see on the screen, but I'm sending alerts out on whatever. So I would say that's the average real setup. When you talk about trading and you're breaking it down, now we tend to think of trading as day trading. I think the day trading just has this cool vibe about it. But when somebody brings up day trading, I would say, okay, great. So if you want the least probable path to success in the market, yes, try day trading, right? Because it's not something it's very low probability to do. But that is where you're actually sitting there and you're trying to scalp small amounts in short periods of time. So you're literally, day trading. You might be out in 5 minutes, 30 minutes, in and out.
Generally, a day trader is going to risk a bigger amount to win a smaller amount in a short period of time.
Correct.
So say I put $10,000 on Apple to move, and I'm not asking for it to move very far, and it moves, half a point, and I'm like, yeah, great. When you put $10,000 on it, it might be worthwhile for you. You might get $500 back. Be like, yeah, that was pretty good. I just made $500 in 5 minutes.
Exactly.
That's kind of the day trading strategy,
Exactly.
generally, if you will.
Yeah, and day traders have an immense amount of discipline too, because to succeed, that is, because of what you have to think about that other side, right? The loss side. It's very, very difficult, if not impossible, for the average person to sit there and keep their losses smaller than their winners when they're day trading. It's a much easier thing to do if you're going into a swing trade, longer term trade, or investment, right? So day trading, that's the biggest catch to it is making sure those losses are appropriate relative to the game. Swing trading, now that is where we talk about a swing. So if someone pulled up the chart of anything and you see a stock go from peak to trough, right? So it's low. Let's say Apple falls to 174 like it did today, bounced and went up to 180 by next week in 3 or 4 days, and then rolled back over again. So that trough to peak of 174 to 180, that's a swing. So swing traders are trying to capture that move.
Mm-hmm.
Now that is a much easier prospect because it's much easier to control losses. And since you're giving yourself more time, you could also get bigger winners. Also, you're giving yourself more time to get a winner. So where the average trader succeeds more often than anywhere is that swing trading basket. Now, where that creates confusion is like, well, wait a minute. What if I go out longer term trading? If I invest, we tend to have this myth in our mind that all we have to do is buy and hold something and we're going to, because, quote, stocks always go up.
Yeah.
Like, well, if it was that easy, why doesn't everybody just quit their jobs and buy stocks because they always go up? Obviously.
Go get a loan and buy stocks.
There you go.
Which people have done previously.
Exactly.
And a lot of crashes.
And they look like champs when things are going up, right?
Yeah, right.
Then you see them, their Twitter accounts shut down and all that kind of stuff.
Yeah.
So they don't want anybody harassing them. But so actually, here's the reason why longer term trading and investing can be challenging. believe it or not, price has character, and price. There are psychological price points, and there are and inflection points, and there are supply and demand zones where, from a short-term perspective, we can look at the right stock and we can say, I think this is going to go from, let's say, 100 up to 105. Or take, for example, on one of the calls you probably heard me do with UPS. UPS came down to 155 2 days ago. And so the analysis was, if we hold and come off of 155, we should go to 160, right? We should do that in a couple of days. Today it hit 160 and some change. Okay. Swing trading allows us to do that analysis, and it's easy. And so what that does is that gives us the framework to evaluate a good risk reward setup, right? And so, as you know, the way you make money in the market has nothing to do with indicators. It has nothing to do with trading platforms. It has nothing to do with anything other than basic math, right? And making sure that you're risking a little to make a lot. If you're risking a lot to make a little, you're probably losing, right? So it comes down. Swing trading allows us to make that evaluation, once we get this setup, okay? Longer term trading and investing, the problem is we can never say, no one on this planet can say where Apple's going to be a month from now, other than I think it's going to go up. Well, that sounds great, okay, but where? And how do I need to have that reward target to know what my risk parameter is to make sure that I'm setting myself up for success. So I always use the analogy of blackjack. For those that maybe haven't played blackjack or don't know the odds and things like that, I've studied it a little bit.
As have I actually recently.
So you know that if you know when to hit, when to double down, when to split, when to do everything like a pro, you just barely approach a 50% chance of winning.
I think it's like 49.6, right? Something
Exactly.
like that.
So then how does a professional blackjack player do it? Now remember, the layperson on the street is going to think that professional blackjack player must be winning most of his hands or something. The reality is that's not the case. It is very similar to trading in the markets, where what does the public do, right? We go up to that blackjack table. Maybe it's hot, maybe it's not. If it's hot, we make our money. We stay there long enough to lose it, give it all back. And then what do? We go to the ATM, we get more money, bring it over, we lose that too. Or we start losing, go to the ATM, get more, right? All a blackjack player is essentially doing is the same thing we would do in the market, which is when they are hot and when they get their profit, they kind of have a stop loss, right? They don't give it all back. They have a target in mind. If the table's cold and it starts to go against them, they, quote, stop their losses, right? They get up, walk away, go to another table. So in other words, we exit that bad stock, we go find a good stock. So all they are using to their advantage is math, not necessarily the knowledge of playing blackjack, right? Anybody can get that by reading a book, right? What they have is the discipline and the understanding of that risk reward, right, in their field to succeed. Trading is the same way. And if we can't, when we look at longer term trading, investing, if we can't make that evaluation, then that's why the public runs into trouble, right? I'm going to this for the long haul, but it's tanking, right? Last year, market down 30 some odd percent. When do I get out? Exactly. Swing trading allows us, and even short-term trading allows us to say, this is where I would get out. This is where I expect it to go.
Okay, so you're not a day trader. So you're a financial advisor, right? That's the other option, right?
Maybe.
So I bring that up as obviously a joke because I know you're not, and we should probably say this is not financial advice for anybody. But most people's understanding of like finance guys, if you will, or gals, is I got an advisor. So maybe for the lay person, what would be the value in starting to understand this a little bit, right? Because even if you don't become a full-time trader, which almost nobody should, right? It's like, oh, I'm going to become a pro athlete. It's like, yeah, well, probably not. Maybe you shouldn't. You shouldn't even try, probably for some people. But what's the importance of like kind of understanding this, even if you do have a guy, if you will, or a gal? Because I think some things that you said to me early on about that and that kind of understanding of how these financial markets work on an internal level help you relate to that advisor if you need them, right? Like we have a 401k through the company. I can't set that up myself. I can go get like an IRA, but it's because we have, we own the business and there's like all these profit sharing things, just complicated, unfortunately. How do you talk to people about their relationship with that kind of person and their relationship with the market in general?
Sure. Yeah, I can't count the number of times that I start to describe what I do and somebody, will say, oh, you're a financial advisor. I'm like, I couldn't be farther from the truth.
Yeah.
What I do has nothing to do with that. When you think of a
And what financial advisors do have nothing to do with what you do.
correct,
On the vice versa side.
complete. I mean, there's no real correlation just because we're in markets. It's kind of like saying just because we all go out here to Sports Ohio over here that we're all playing soccer. And, well, there's any number of things you could be doing over there, right? So just because we're playing sports doesn't mean soccer has anything to do with tennis, right? So similar scenario here. Financial advisor, you're typically thinking about someone that's managing your money, and commonly what that entails is that they're simply putting based on your parameters, they're allocating your funds through into whatever buckets that their parent company, the parent company is telling them to, right? So there's no real stock picking per se. There isn't really necessarily any ETF or fund picking, right?
Right.
There's a mathematical formula. You retire at this day, you have this risk tolerance, right? So you're going to be put into this, right? Same thing that would happen with my children, my daughter's 529s, right? So I'm not necessarily picking. What someone can do with my advice to anyone when it comes to that type of money is you probably do want a financial advisor. You probably don't want somebody picking, hand picking things. And the reason I say that is by far and away the most important attribute of successful trading or investing is the ability to be disciplined and to control emotion. And you probably experienced that yourself, right? It's very difficult. You put that trade on. I always say when it comes to my trade services, that you guys don't pay me for trades. You pay me to not be emotional. You pay me to make sure the plan goes through, right? And so if it doesn't, I'm not going to, freak out because we're up 10% and we might lose it, right? We have that plan. That is very difficult for virtually everyone. So you definitely don't want to be emotional about retirement money, right, in your future. And if you don't feel like you can be non-emotional, then you want to let that person do that. Now, there are some that believe that they can. And so what I will say to them is you can do much, much better on your own than any financial advisor ever could.
Hold on a minute. Are you telling me that I could beat the market?
Correct. You can, and I wouldn't say you would need this vast knowledge. I think with some basic understandings of price action, trends, momentum, and I know that may sound like a lot, but you and I have been through a lot of calls together, and once you kind of see it, it's not as hard to follow. So yes, but again, now we circle back to the same thing. Can you be disciplined? Can you stick to whatever plan you put in place? Right. So.
Yeah, and I think you hit it on the head there moments ago. Your financial advisor is not picking individual stocks for you to invest in. They're sending it up to Principal, and Principal is investing in. Principal does have traders, right?
Right.
Like they have a whole mess of traders. Those guys and gals are sitting somewhere and they're exclusively focusing on that every single day of the week. Your finance person is just saying like, well, Principal has this 20-year target fund. It's going to be good for you, right?
Right.
So, that is an important thing to make mention of. I don't want to say that financial advisors are glorified salespeople, but many of them probably are. Is that, because again, they're not in charge of picking your stocks. They are selling you a product that has stocks that someone else picked.
I would agree with you. That's probably a more accurate definition. It's sales and customer service.
Yeah.
Like they are your rep, they are your account manager, but it's not like they can't go rogue. They can't just decide, what, I like gold. I'm going to buy some GLD for my clients. They can't make those decisions. And so, typically it's just a formula, just an algorithm. We've all filled them out, right? When you plan to retire, how much
risk
income.
tolerance.
There you go. And then you get put into this percentage of bonds and this percentage of, high risk, maybe small caps, this percentage of large cap, et cetera, et cetera. So, yeah, I would say that's closer, more accurate than they are literally controlling your money. That's where, if you have the knowledge, which I do believe that people can gain that knowledge. What I can't guarantee anyone is that with that knowledge, will you manage your money and your accounts and your investments appropriately? That's the challenge.
Yeah, so I wrote down here, my second question was, can you beat the market? I know you kind of already said that you could. And Steve, you could do this. You can go to Google and just search, can you beat the market? I did that, and the first thing that pops up is, beating the market is difficult and, according to some widely accepted theories, may be impossible to do over the long term. So why is there such a belief amongst people that you cannot beat the market? And so I was just going on a walk with someone and they said, "Well, I've heard that you can't beat the market." And I was like, "Well, if you just invested in Tesla 5 years ago, you beat the market." I
Mm.
think it's one of the most highly performing. I don't know if it's the highest performing stock over 5 years, but it's one of, if not the highest performing stock, right?
Yeah.
Every index that you buy has Tesla in it. So what if I just skipped that and went straight to Tesla? I would have 100, it's almost like 1,000% return, something like that. Yeah, Steve, I don't know if you could just even going back like straight to Google. I don't know if you saw like the first thing on there. There you go. So the first thing that pops up when you search Google is average investor may not have a very good chance of beating the market. Regular investors may be able to achieve better risk-adjusted returns by focusing on losing less. It's funny because this is a little bit different than what I got, but generally everybody's mindset goes, it's impossible to beat the market. Where did that come from? Like where is that origin story for that phrase? Because so many people I know think that way, and because even really popular investment gurus like Ramit Sethi, he says like you can't beat the market. All these studies say you can't beat the market. Don't try. You're wasting your time. You're wasting your money. Are they wrong? Are they right?
Well, I would agree with that first sentence up there. The average investor may not have a very good chance of beating the market. Absolutely. The average entrepreneur is going to fail too. What is it? 90% of all businesses go under within their first, was it 1 or 2 years?
Yeah, first couple of years. If you make it to like year 5, then your percentage goes up of survival, but then your percentage of making it to year 10 is still incredibly low. If you make it to year 10, your odds of getting to year 20 are incredibly low. So it just like continues on. The chance of failure never evaporates really as a business owner.
Exactly.
Statistically.
So how small must that number be, right? For those that actually succeed, are we talking inside of 5%? Are we talking inside of 1%? But we would never make the statement that
A business cannot succeed.
right? Okay. So now let's circle back. Is it impossible to beat the market? Well, of course it's possible. How many fund managers? I mean, Warren Buffett. How many hundreds and hundreds?
Thorp, Ray Dalio. There's so many out
You
there.
can go on and on, right? Thousands of investors or fund managers beat the market. Traders. Okay, so off camera, so to speak, we were talking about the turtle traders, and I was telling the story about the turtle traders from back in the 80s. Just as one example, that was the story where his name was Richard Dennis, had a business partner, and they were kind of talking back and forth about whether or not successful traders were born or could they be trained. And one of them believed that they were born. Richard Dennis believed that they were,
Interesting.
or that they could be trained. And his partner, if I remember correctly, was no. I think you either have it or you don't. So he goes on a trip to Thailand, I think it was, somewhere Southeast Asia. He visits a turtle farm, and it gives him this idea of growing turtles. And he decided he was going to hire random people off the street.
Whoa.
They just put an ad in the paper, which was unheard of.
This is a true story?
This is a true story. Okay, the book's called The Complete Turtle Story.
Wow, this needs a movie. Is there a movie?
Well, some people compare. There you go, Richard Dennis. There you go. So some people compare it to Trading Places. This idea of making the bet. The Mortimer and what's his name, Duke and Duke, right? So they place this bet on whether or not they could flip this one guy and turn him into. So what ends up happening is, and you can see it right there, they end up hiring these traders, and sure enough, I think it was a 2 to 3 year window. I want to say it was somewhere around 20 or 30 total turtles, as they called them, but they made him over $100 million in 80s dollars.
Whoa.
Okay. So just as an example, but any
Do we know
number.
how many turtles there were?
They only hired like 20. I want to say it was like 24 or so. And what's amazing about the book is they have the track records in the back.
Wow.
And what was, I did a presentation years ago in Vegas where, and it was all about risk and reward. You can see they talk about, and it was a very simple approach too. It was no frills like what we're marketed to believe we got to be doing today. It was simple: buy when this hits, sell when this hits. That's it. Don't question it. So these turtles were kind of locked in a room. They weren't allowed to do the nonsense we do, right? Getting caught in the, I always joke about CNBC or Fox Business, and they got the the debt clock ceiling. Remember that? Like, oh my gosh, the entire market's going to implode when this gets to zero,
Got
right?
to
So
count down until
yeah,
Powell announces
it-
the next rate
countdown
hike.
until
Oh
oh my
no!
gosh, here we go, and then we get emotional, and then we can't control what we're doing. But they made all this money, and they weren't allowed to consider fundamentals. They weren't allowed to watch news. You buy here, you sell here. You know, good risk reward. Let profits run. Get out, and obviously they made again well over 100 million in those dollars. So. Um, the point being, just like any other traders now, there are thousands of traders that are making a living trading. So my point is, yes, you can beat the market. That's not up for debate. I would say the odds are just as low, maybe better, but around successful business. So I don't know why, to get back to your initial question, I don't know why there's this perception about beating the market, but there isn't the same perception about business. I think it's all a matter of running a business isn't for everybody. Not everybody is meant to be in the market, but
Yeah, and I think that there's sort of that prevailing idea that you cannot beat the market out there. So when people are thinking about starting a business, they never think about, I'm going to become a trader. Like people who become traders are like these kooky guys who are like addicted to playing blackjack, or they're going to the casino. They're like, I'm going to become a stock trader. You know, like I'm sports betting.
Yeah.
Let me trade sports betting in for, gambling in the stock market, right? Like I don't see out there people who are like, I'm an educated business person. I have a variety of different options that I can pursue. I can start a real estate business. I can start a storage unit business. I can start a, equipment leasing business. I could, start an Airbnb business. But I'm going to choose to go into stock trading. Like, why do you think that is out there? You know, you and I have talked about FBA, Amazon FBA business, right? Like, that gets marketed to people, and I know what the inner workings of that business is like, and I'm like, that's really difficult, you know? Like, that's, as stated, a low probability business. Could it work? Yes. But I don't think a lot of people think of trading as a legitimate business. And one of the things you told me is, if you want this to be successful, you must treat this like it is a business.
Exactly. You and I gave that analogy to you just like I give to all my students. And it's one of the biggest pieces of advice any coach in the markets would give is if you truly want to succeed in trading, this isn't like what you see in the boiler room with Vin Diesel and Giovanni Ribisi, right? This isn't what you see in, necessarily even Wall Street for that matter. This isn't this cool stuff where lasers are shooting off in the background and there's little dry ice on the ground with the smoke, and there's the
Not
Ferrari.
Jordan Belfort.
It's
either.
not any of this stuff. It's actually a job, and it's hard, and it's work. Those that succeed treat it as such. So you heard me talk about when you think about the stocks that you build your watch list with, you want to look at those as your employees. You want to get to know them. So going back to my statement from earlier, a lot of the trade alerts I send out, a lot of the trades that I put on, I don't ever have to look at a chart because I know my stocks. In other words, I know my employees, and I've gotten to know them. I know, right, that Tesla probably has a resistance area around 280 right now. I know Deere, if it goes up, should go to 420 because, like my employees, I know what car they drive, what time they come in, what their name is, so forth and so on. So I think that it's that kind of perception that you see, whether it be in marketing nonsense, a lot of the YouTube nonsense with crazy guy and looks like he's selling couches over here, whatever, with the big stickers on the windows. So I think that paints this perception that traders are like that, but the reality is, like, traders that are really getting it done, it's stressful at times. As you have seen with my trade service, we go through drawdowns, and that's the reality of it. But if you can treat it like a business, now to your point, why would someone not choose trading as a business? I do think that if you go to start any other traditional type business, I believe that not only is there the perception, but also the reality that your outcome is in your control. Okay. So if you decide you want to, let's say you want to start a home improvement. I had a home improvement business, which is why I'm using this as an example. I learned very quickly that it was in my control. If I knocked on 20 doors, if I hand out X amount of flyers, I'm going to get X amount of calls. I can sell this deal, so forth and so on. So it was just a matter of scaling me, right? I knew I could get this, and so it's in my control. Okay. If I don't get out of bed, then I don't sell any siding that day. I don't sell any roofing. But if I get out of bed every day and I do my job, right, it's in my control. Trading, on the other hand, it's not really in your control per se. we can't control what a stock does. As you've heard me say many times, markets reserve the right to change their mind, right? One of the best calls that I've made here recently was when I called the bear market. So I get asked a lot, just like I have for 16 years, like, oh my gosh, like you're a genius. How did you do that? I'm like, no, I'm not a genius in any way, shape, or form. I'm trained in reading the market, price, momentum, breadth, sentiment, so forth and so on. And the market was sending a signal that it's planning on dropping to a large scale. Now, for every one time I get it right, there's also going to be those times where we get it wrong. That tends to happen more often on a short-term scale than a long-term. The longer-term signals tend to be the most reliable. But the point I make to everyone is the market reserves the right to change its mind. It could have very easily on Wednesday told me this security is going higher. Then the next day it says, changed my mind. When we go out and start a business, right, we don't have to worry about that necessarily. Like if we are willing to put in that quote hard work, which in the businesses I've operated, whether it be home improvements, I had a notary business, real estate, things of that nature, it always felt like it was in my control what was going to happen. With the markets, overall success is in your control, but kind of like those profits on a day-to-day are not. So
A little bit less predictable, maybe.
and it feels less, I would say, less predictable. It feels less in my control. And I know that for most that I've worked with, it feels unattainable. Like there is no way I could master the market. But a lot of us feel like we could run a business. I'm like, wow, yeah. I don't know that one's harder or easier than the other per se. It's just a different education.
Yeah, and a lot of my friends, they're really into real estate, and I've kind of it's not to say that I have any issue with real estate, but my sentiment is that if you can instead just deal with things that are incredibly liquid, like we're 2 clicks away from having cash on everything in our portfolio, and then we're like 2 days from having the cash in our account. I'm like, well, that's pretty good,
Yeah.
You buy a piece of real estate, you are locked into that thing, at best case scenario, like 60 days from the time that you want to sell it to the time that you're actually getting cash in your pocket. And there's all sorts of things outside of your control within real estate. Obviously, there's things outside of your control in the market also, but cracked foundation, you have flood, bad tenant, tenant's a smoker, house stinks now, fire, tenant squats. I'm like, there's a lot of things that are unpredictable in that situation.
Yeah.
You can make the best decision that you possibly can with like the house and the tenant and all that, just like you can make the best decision with whatever stock you are choosing to trade. But I just like that it's liquid, and I think the profit potential is very, very similar, if not better, while trading than it would be with something like real estate or storage units, things like that. And you can do it all from your computer. You can do it all from your phone. You don't ever have to go out to a job site. You never have to go to a house. No plumbers you have to call. So that's kind of what attracted me to this. And I do have a portfolio of real estate, but I think that if I could transition things into trading, the longer I trade, I feel like the better I'll get at it. And, the better I get at it, the longer I go, the larger my portfolio gets. The easier it actually gets, the larger your portfolio is, because you can just do things more safely, right?
Sure. Yeah, and I would say it also depends what you're trading and investing too. Like I do think that options are harder. You can make some big bucks, but it's also a very, very easy way to get wiped out too. And that's what the average person tends to do. So like if you go out and buy Tesla tomorrow, right, the stock, what's the most you're going to lose tomorrow? 5% maybe? If it has a bad day.
Maybe $10, $20. It's been volatile recently, maybe $20.
Right, yeah, if that thing fell to 260 tomorrow, that'd be a pretty rough day. So if it dropped, or what was that? It closed around 275, 276 today. So you're losing $15, $16. What'd you lose there? Like 6%, right? If you had calls on that, right, you just got wiped out. You lost 100%. And that's where, on one hand, it's very appealing to the public because it allows easy access to get in the game, right? So you could buy those calls for $100 if you want to. You could buy them for $50, depending on which ones you bought. But just like that, just like when we put on our lottos, just like that, we can get wiped out. So stock trading can be simpler and easier too, just because of how there's a built-in mechanism, so to speak, to prevent you from losing your shirt.
I think this is the right time to maybe allow you to explain the difference between a stock and an option, and you're pretty much exclusively trading options. So that's a fundamental piece of the puzzle when it comes to trading is derivatives.
So full disclosure, I personally do trade some stocks. But yes, you are correct that what I advise, what I teach, the services that I operate by demand is options. Now, I do have members and students where I kind of work with them one-on-one um, via message and email, where I help them with stock ideas and
Mm-hmm.
such. But the great thing, when you talk about buy the stock, it's pretty straightforward stuff, right? The shares that you're buying. What Nvidia closed around 450 and some change, say 455, something like that. You want to go out and buy a share, it's going to cost you $455.
Even now, like Robinhood, you can buy fractional shares. You don't
Yeah,
even need to buy the
yeah,
whole which is kind of a new development in the stock world. It used to be you had to buy the whole
yeah,
stock. I mean, Berkshire Hathaway was like tens of thousands of dollars. Now they have like their Class B shares, I think, that are a
yeah,
couple hundred. But you don't even need to buy the whole stock anymore.
yeah. I always forget about that too. You can buy those fractional shares and such, but yeah, absolutely. And the great thing about, if you go out, let's say you had $1,000, you want to buy 2 shares in Nvidia. If Nvidia has a bad week or two and drops 10, 15, 20%, you still got $800 in your account.
Yep.
And so there's a certain amount of solace in the idea that I can't get absolutely my entire portfolio wiped out. What options are, as you mentioned, like a derivative of the stock, but
This is where people's start to their head starts to
yeah,
spin. Like
yeah.
what? Like what?
Yeah, this is why I was like, you need to, like, here's my training. Yeah, watch that first. But let's keep it as simple as possible. Um, and let's stick with just like call options. So there's obviously 2 options: calls and puts. These can be put together in any ways. Let's stick with calls, I think, because it's kind of simple.
Definitely.
The more simpler thing. It's very difficult for people to wrap their minds around
Yeah.
the idea of making money on the way down.
Yeah, and this is not a short, correct? So
Correct.
people have heard about shorting a stock.
Yeah.
And it's similar, but it's not the same mechanism. Basically, a short, you believe the stock will go down.
Mhm.
Similar to a put, you believe the stock will go down.
Exactly. Yeah, and it's probably best to keep that as simple. But to be honest with you, so many times I've coached students. I mean, I would say a big chunk, maybe I'm not going to say majority, but a large chunk don't even know that you can short stocks. Now, not everybody can do it.
Mm-hmm.
You have to have certain authorizations and capital levels to do it. But yes, you can. Just like you can buy a stock at 100 if it goes to 105, you make $5. You can short a stock at 100 if it drops to 95, you lost $5, or you make $5 if it drops.
And the popular news on shorting is probably everybody remembers Michael Burry, the guy who shorted the market during 2008, the financial crisis, and he made billions. Basically, he bet that the market would go down. The other one is the GameStop thing, where all these hedge funds, they had short positions in GameStop.
Yeah. Those are 2 fascinating examples that you bring up. The GameStop thing, that is so complex.
Yeah.
Because a lot of what most associated with is what we call a short squeeze, which is simply when you get a high level of short. If the stock starts to rally and the short's got to cover, you want to keep in mind that when you short a stock, you have borrowed shares to then sell them on the open market. Okay, so to those of you that aren't familiar with that, that's what you're doing when you're shorting. You're selling them to me at 100 because I think it's going to go up. You think it's going to go down. It drops to 95. I lost $5. Guess who made that, right? So you're buying it back at the 95 and you're giving those shares back, okay? When you think of a short squeeze, when a security gets heavily shorted, all it takes is like a match almost to light this fire, where once the stock starts to rally a little bit, and obviously there's the Reddit army that helped induce this, okay? But when you have to close your short, you're buying it, right? So it starts to become a feedback loop or a self-fulfilling prophecy where now the rally takes on a life of its own. More shorts have to cover more shorts, and pretty soon it starts to explode. Where you run into issues with the meme stocks with what they also call a gamma squeeze, right? So I'm not even remotely going to try to cover a gamma squeeze on this because you're talking about options Greeks and gamma and things like that. But that was a fascinating story. The Michael Burry and the Big Short, now different than shorting, what you bring up is a good point. When we refer to the terminology of shorting, even though we're not shorting anything when we buy a put, it's the same idea.
Mm-hmm.
When Michael Burry shorted the housing market, although he didn't short anything, what he was basically doing was buying credit default swaps. So he was shorting it that way, so it's the same idea. Fascinating stories if you people want something to put them to sleep at night. But to get back to your question about options, and again, sticking with calls, a call option is simply it's a derivative. It's you're buying the right almost like a lease option on a house, if you will. When you go into a lease option to buy, you're controlling the house, but you don't own it, right? You have a lease with the option to buy. A call is not too much different. Okay, you're almost like leasing this stock. So let's say we buy a call option on Tesla at 280. It's kind of like we are leasing the house with a purchase price of 280, if you think about it. So if I lease option this house for 280,000 and they're giving me the option to buy at 280, I control it, right? Let's say that house gains in value over the year that I have that lease. Okay, think of that as your call option. If it goes up to 300, well, remember, he gave me the option to buy this thing at 280. So I buy from him 280, sell it for that 300. I just made 20 grand.
Yep.
But I never actually owned that house. Okay. So when you think of a call option, think of the same thing. When you buy one contract, let's again talk about Tesla at I think 275 today. I might want to go ahead and buy the 275 calls. What I have done is the same idea. I now have the right to own Tesla at 275, and they're going to charge me a premium.
Yep.
The same way a lease option is going to ask me for a deposit, right? Yep. So I'm going to pay, maybe we'll call it $2 to control this and to own it. So let's say Tesla goes to 300. Well, I have the right to own it at 275, but it's worth, like that house, 300. So my calls are now worth $25. Okay. So a call option allows that type of leverage. Instead of buying this stock for 275 and possibly selling it for a $25 gain, not bad, right? Almost 10%. I don't think anybody would, get upset about it. But if that call only cost me even $5 to buy those calls, but I can sell them for 25, I just made 400%. Right? So those calls, call it $5, call it one contract. You just did that for $500 and you made, right, $2,000.
Yeah, that's what really kind of got me to open my eyes, is those percentage differences that you can make with hypothetically risking a small amount. To your point on the options, the sort of best way I ever heard described was, like you said, if there's a house, let's say it's a house and maybe it's in a bad neighborhood, and someone gives you, I don't know, it's worth $250,000 today, but I'm really of the opinion this neighborhood is going to turn around over the next year. So I'll give you $1,000 today to own your house at $260,000 in the end of the 1 year time frame. And then as 1 year goes by, if the neighborhood gets a lot nicer and it's worth $270,000, boom, great, I made $10,000 there minus the $1,000 I paid. If the neighborhood got worse than you thought, now the house is only worth $245,000. You just walk away, but the other person keeps the $1,000 as sort of that. Hey, you got to pay me a premium, to give that risk. And that was sort of the easiest way for me to understand it. Is that makes sense. An option to buy the thing at a future date.
Exactly.
Just like, I don't know why, but real estate just seems like more tangible. People kind of get that. But to your point, if you, like in that instance, I paid $1,000 and I made $9,000, that's an enormous gain when it comes to stocks. Like we said earlier, the best performing stock over the last 5 years was Tesla, and it did that basically. It was like 900, 1,000% gain. That's the single best performing stock. Me, I just made like one good deal, certainly a good deal to make that 800%, but it's not that crazy when it comes to options, because especially if you give yourself more time and you pick far enough away from the actual price, those are possible. So that's where I started to go, this makes a lot of sense why people trade like this, because instead of, Tesla going up, like you said, $10 and I make 3%, great. If it goes up $10, I could make 400% gains on that.
Yeah.
And that's why I tell people, like, hey, if you're interested in financial markets, like, try to figure out how options work. Even if you're never going to trade options, I think this is really important and valuable to understand how they work.
Yeah, not to mention there's great option strategies out there to protect your retirement,
Correct.
your investments. So
Do you maybe just want to talk about that, like why different people buy options?
Sure. Yeah, I mean, obviously what you and I have been talking about is context of trading them. So for sure. And Tesla, I think, is one of, if not, it might be the highest options activities on Tesla. Any number of reasons for that. But I think, you look at trading, but then there's some really unique things you can do with options once you understand them. So when you look at, say, for example, one of the courses that you and I went through with the more advanced strategies, right? There's a lot of ways those strategies are used where it's not necessarily about trading. You look at something like a covered call. It's a way to, let's say you owned that Tesla and you just wanted to pay yourself your own dividend, right? I want to own Tesla forever, but I want to lower my cost basis. You can sell calls against your position. So let's say you own Tesla right now, and next week's 300 calls, I don't know what they are, but I'm going to guesstimate maybe somewhere buck or two, somewhere here and there. You can sell those.
And when you say a buck or two, I think it's important for everyone to know all options are times 100 shares.
Correct.
$1 would be $100 you would have to invest to own that option.
Exactly. So if our premium is $3, well, yeah, if I want to buy a contract, that's $3 times the 100. So yes. So what you would be able to do, and those that are kind of, there are people that really love their Apple. There are people that love their, Amazon, and like you mentioned, Tesla's another big fan favorite, where people want to own these forever,
Yeah,
right?
there's this Tesla shareholders out there that, believe that it's going to be selling its, self-drive mode in the future, and it's going to be an AI robotics company, and it's like, maybe, I don't know.
They are very passionate.
They are very passionate, yes.
Same thing with the Bitcoin bros out there, right?
Yep.
They're very
Yep.
passionate about that. And I'm not here to tell them that they're wrong. But the great thing about, say, a covered call strategy is if somebody, okay, I'm going to own Apple until I cash out my retirement. And that's 10, 15 years from now, whatever that happens to be. Well, you can start paying yourself your own dividend by selling calls against. And it's the easiest option strategy to get access to because no one's really at risk. You own the shares. So, you're selling these options to somebody else, and the market makers and your brokerage is allowing you to do that. Because remember, this is where it can get a little bit head spinning, okay? But remember that when you buy a call, you are buying the right to own that stock at a certain price. So if I'm the seller of that option, in this case, let's use Tesla 300 example, I am selling someone else the right to buy Tesla 300.
Mm-hmm.
So the risk I take on is that if the stock goes up enough where somebody wants to take ownership of those shares, then I could lose my shares.
Yep.
But a lot of good things happened in that process. That means my Tesla shares went from 275 to 300.
Mm-hmm.
And it also means if I sold that option for $2 and I had 100 shares, I also made that extra $200.
Yeah, to go back to the house example, on either side, that's a decent transaction, right? Because I own the house for $250,000. You want to buy the call option on my house at $300,000, and I'm like, it's not worth $300,000. I'm like laughing, sure, whatever. You want to pay me $1,000 to take my house off my hands at $300,000? Sure, go ahead. But yes, if it gets to that drop dead date and the house is worth $302,000, you do have to sell it for that $300,000. Mm-hmm. Now you made that $1,000 that I paid you because you kept it, and then you also get the $50,000 on the gain from what you maybe purchased the house at or believed the house was worth, right?
Yep.
So it's a benefit if you're a covered call seller and that you get kind of two wins. But yes, you might lose your shares and then have to, if you're like, I really want that Tesla stock, you have to go back into the market and buy those shares if you want them again.
Exactly. And so it can get tricky in that regard, but those that are really good at it, a lot of times what they're doing is they're trying to make sure that whatever strikes they're selling, that there's a very, very low probability because they don't want to lose their shares.
Right.
But the way they look at it is, well, what if I owned NVIDIA right now and I could sell next week's 500s for $1? Every time you do that, you've lowered your cost basis. Yep. So if you spent $450 on NVIDIA, you just lowered it to $449. If you're planning on owning this thing for 10 years and you can get that dollar every month, so that's $12 a year, $120 that you will have paid yourself in dividends in 10 years, you lowered your cost basis from $450 down to $330. So if that thing didn't go anywhere, you still made all those dividends. And so that's the appeal of like a covered call strategy. And then there's certainly another one that's common, but this one you really have to be high up on the totem pole of options trading when you talk about selling naked puts and naked calls. So this is not covered like it is the covered call where you own shares. You don't own these shares and you're selling these options, in which case you might have to go out and buy some shares now if it goes against you.
Yep.
But it's a very big income strategy. So if somebody can afford to do it, if somebody can afford to say, you know what, I'll sell NVIDIA's 400 puts for next week for $1 or whatever they happen to be. And assuming NVIDIA stays above 400, somebody with the bankroll, right, sell sell 1,000 shares, they're gonna make $1,000 next week.
Yeah, what was interesting to me is if you have a big enough cash portfolio or a big enough stock portfolio for that matter, you can generate quite a bit of income hypothetically on a daily basis because there's daily options on the S&P, and then there's dailies on the QQQs, things like that. Like if you had $100,000 worth of cash, then you could sell a lot of naked puts on the S&P 500, and you could probably make what $500-$600 a day, potentially, and not subject yourself to that much risk because you could either sell it out of the money, or if you're like, well, hey, it's the S&P 500, it's going to bounce up and down, up and down. So like, even if I do have to take possession of $100,000 worth of shares, okay, I just sell a call above it. You kind of wheel the wheel strategy is what I've heard it called.
Yeah, for sure. Same thing with somebody that, let's say you're waiting for a pretty good breakout or you see a pretty good reversal in the market or an individual stock. Like when UPS hit that 155 and you see it reverse, you could go out and say, you know what, I think this thing's going to go higher. I'm going to sell the 155 puts or something low, or 150. Might not be a lot of money, like say 50 cents or something, but if you do 10 contracts and you're right, that's $500. And like you said, you do that across 10 stocks or something. It's a pretty big day for you. So the great thing about strategies like that is something like that, you don't necessarily need to be right when it comes to up or down. You just need it not to go down too much. Right. So there's a lot more complex strategies, multi-leg strategies, some of which you're familiar with that we put on, right? Straddles and strangles and such, which I won't get too much into. But then there's some more complex ones where you're buying and selling, where you can drastically reduce risk and such, where you don't have to be directional either. But as you know, those strategies don't bring in those big gains we talk about, but it's really good at mitigating risk. So when we do calls and puts on a lot of ours, as you have seen, it's not uncommon for us to get wiped out, where we take 100% loss. Now, we take that into consideration with our trading approach, knowing that, well, because we are going to take those types of losses at some point, we need to make sure some of our winners are 200 and 300%ers. So that's why we never put on trades that don't have that potential. Right? So,
yeah, and some people will use options just as a hedge against risk, right?
Yep.
Let's say you got a big portfolio of the S&P 500, you're nervous it's going to go down. Well, I'll buy a put, If it does go down, then I got that put and I'll make money off of that put and maybe I'll cover my losses there.
Just an insurance policy like you would buy on your house, your car. So not uncommon.
So I know you already talked about technical analysis. You talked about fundamentals a little bit, but what is your view on like fundamental analysis, right? That's what Warren Buffett does, right?
Yeah.
Warren Buffett's one of the best ever. So he's probably not wrong. And that's kind of where your approach to technical analysis changes, because Warren Buffett looks at the financials, the officers of the company, all of those things. And I think that's where everybody else like wants to generally think about trading in the stock market and so on. But I know you kind of vehemently think of things the other way. Is one better than the other? There's a lot of information out there. There's stocks, there's options, there's futures, there's commodities, all these things. Then there's technical analysis. Then there's fundamental analysis. There's all these ways of thinking about it. Like, why are there so many different ways of thinking about it? Why can no one find a consensus on this?
Well, I'll start with, do you ever see Ghostbusters 2?
I'm sure I did. I don't know which one that was, though. I'm getting lost in my Ghostbusters.
Well, they had that purple ooze river that was going under.
Yeah.
So
the painting who came to life. Yeah, that was a good one. That was my favorite one.
Vigo. The reason I give that analogy or bring that up and draw an analogy to the market, I always say think of the fundamentals. So whether it be individual stock, S&P, whatever, the fundamentals is that underlying current. But it's a slow-moving current that really doesn't have any effect on a day-to-day. The reason why I can get sometimes like bitter about stuff like that, and same thing with news, because I've seen what that's done to so many students I work with, where they've been conditioned because of the instant news and the instant breaking news every time something moves. This belief that stocks are that they're not moving without some sort of fundamental thing or some sort of news. I'm like, well, think of how silly that might sound. So you're saying in absence of news, stocks just wouldn't move. If you think that's the case, then why were stocks moving 75 and 100 years ago when no one had access to news? They're going to move no matter what based on just supply and demand and doing their thing. But I always like to bring up a research paper that was conducted by this is going to drive me nuts now. I can't. Vanguard.
Okay.
Vanguard did. This had to be at least, I'm going to go 12, 15 years ago. And I kept it, and I haven't really been able to find it since, but it was a research where they had went back something like 75 years of data or something like that. Now, I might be getting some of the details wrong, but the general thesis of the conclusion was they went back and looked at all this fundamental analysis and prices and things like that. And the conclusion they came to, and this was their words, not mine, fundamentals useless when anticipating stock returns. Okay. Now, what they went on to say was they weren't saying that fundamentals weren't a factor, but what they were saying was that fundamentals by themselves are not the reason why things do what they do, and not the sole reason. So, not to poke Warren Buffett or anybody, Peter Lynch in the eye or anything like that, but
They've done well.
they've done pretty good. But I also like to point out that Warren Buffett also has technical analysts on his team. So let's be clear.
Sure.
If you hear some of the things he says, he's talking about technicals.
Well,
right?
yeah, and also, his investment strategy has not probably been the same exact thing over the last 75 years. It's changed quite a bit, and he's a smart guy, and he's invested in a couple of enormous companies that have outsized returns for his portfolio.
Exactly.
I mean, I think right now, like a quarter of everything he owns is Apple.
Right.
Like a lot of people would say that's unwise because you're like so isolated to one company, but he just has a lot of belief in Apple.
Yeah.
And it's worked.
Like Occidental, I think he owns like half that company now without the shares he's bought.
Yeah.
But one of the things what was interesting about Vanguard's conclusion was they were pointing out that there are any number of factors that affect stocks, and you want to take in consideration just the overriding market. Okay, when market drops 5-10% or something like that, Apple's probably going to drop 5, 10, 15% as well. Apple's down pretty good off its high. Did Apple magically change as a company in a week or two or a month?
Well,
No.
China's going to ban the iPhone, Christian.
That's the
news.
right. That's the making, as we call it, making the fundamental story fit the price action shoe. Nobody said anything about China when Apple's price was hitting highs, right? But magically, China just showed up on the. They just showed up and they just started, right? So it's all kind of silly. It's this idea that now that the price is dropping, we have to explain why.
Yeah.
It's not to say that the why isn't true, but that why was probably there before, and we never really assessed it to. It was like, well, who cares about this competition or them banning this, that, or the other? Or a lot of times this stuff has been in the works for a long time. So the point being that, look, just simple market corrections that are going to happen naturally can do a lot of damage to stocks where fundamentally the company never changes, right? Mm-hmm. But what Vanguard was pointing out was, one, fundamentals are a factor, but there's any number of other factors that affect the market. So, for example, day traders, we've already talked about. Day traders don't care what a company's doing. They're trying to capture a 15-minute gain. Right. But they affect the market. High-frequency trading, right, where this is just a matter of speed, right? This is a matter of trying to catch a penny or two ahead of the run, right? So what does that have to do with fundamentals? All of us, technical analysts out there that could care less, all of us are affecting the market in any number of ways. Algorithms, right? Program trading, things that have nothing to do with fundamentals. Some would say things having a bigger effect than the average investor, right? And so the point that they were making is, look, fundamentals are one factor, but fundamentals in and of themselves are useless if you're going to try to anticipate stock returns. You need more than that. So when I coach it, I always say, look, you can marry these two things. You could think fundamentally, I think NVIDIA is great. And then look at for a technical trigger. Okay, when is price proving me right? Okay, I always say, well, you could think it's the greatest company in the world, but if the stock keeps dropping, the market's telling you what it thinks. Which one's right? You or the market, right? Your bank account keeps dropping, so I think the market's right.
I've met some people who are like so obsessed with a company and MicroStrategy. Remember MicroStrategy? Yeah. I had a friend, he was obsessed with MicroStrategy. He would talk my ear off about it. He knew everything about it. And I was like, okay, cool. I'll buy like $100 worth. I don't remember where I bought it, like $13 or something like that. And I don't know what it is now. It was like at $6 when I sold it. It was just going down and down and down and down and down. And I was like, this does not seem like the company that I was pitched. Hold on a minute. I thought this was going to go to $1,000. Yeah. But he knew everything about it. They have LiDAR, Alex, and they have all these, fundamental technologies, and Google's going to use it in Google Glass and all this stuff. But the market didn't agree. The market just let it drop and drop and drop.
Well, yeah, and that's what when someone that is an investor type, when I'm talking to them and they're trying to make this case for me, um, whatever their case is on this stock, and some pretty neat, studies that I was privy to when I became a CMT. I remember one where they did a test where and they did this for I don't know how long, once a year, but it was a rolling 2 years. So every year they would buy the highest rated companies from analysts, and then they'd also buy the worst. And they kept doing this
Mm.
every year, and then they would let it run for 2 years. And every single time, the worst of the worst always outperformed
Wow,
the
what
best.
what a strategy
Yeah.
there.
So it's like if you want to beat the market, do the opposite of what the analysts are
But
saying.
isn't there like a joke
Right?
about that with like Jim Cramer, just like buy opposite of what
Yeah.
Jim Cramer
The
tells us to
inverse Jim
do?
Cramer. He's got the
Yeah.
Twitter handle, which is kind of funny, by the way, because he's pretty good at being wrong. Like,
I mean,
a lot.
well, and that's something that you always will tell me is like, anything that you're saying, it's not declarative. It's like, this is what it looks like right now.
Yeah.
But as you stated, the price, the market has the right to be,
Mm.
how do you phrase it?
The market reserves the right
Market
to change
reserves
its
the right
mind.
to change its mind.
Yeah.
Absolutely.
So,
And it's just difficult to predict. And I think that's what the ticket is sort of on swing trading is like you can't predict what's going to happen with Apple. Yeah, we all think that Apple's going to keep on going and growing, but what if China does ban it? Well, then what if India bans it? And then what if they have a hack? What if their CEO comes out with like racist comments? You're like, oh,
yeah.
geez, all these things are bad for the product, and that's going to impact the stock more than it impacts the fundamentals generally of the underlying.
Oh, for
company.
sure. And when you look at, and to circle back to a comment you made about predicting and forecasting. So it's unique. It's interesting the way you want to look at this because we are predicting and forecasting a direction, but you can't make money off predicting and forecasting direction, right?
Mm.
Because we're going to be wrong sometimes, right? We're going to be right sometimes. And we could perform the same analysis on 50 securities. And it's something I teach my students when a trade goes against them. What did I do wrong? Like, well, who said you did anything wrong? Well, I took a loss. I'm like, oh, you think successful trading is about 100% winners? Ah, no, I don't think that. I'm like, well, that's what you just said. I'm like, well, no, I'm just saying I took a loss. Didn't I do something wrong? No. Okay, you can go out there and perform the same action on the same securities all the time. The market's just going to give you some and take some, right? So on one hand, we are forecasting and predicting, direction, but like that blackjack player, when he's predicting the hand and trying to make places bets, and that's not how your money is made, though. Your money is made by making sure you keep your risk small and making sure your winners are bigger, right? So it's like on one hand we are doing that, but on the other hand, that's not how we're making money, right? So, but yeah. So to your point earlier about the investor and the stock going down, what I always tell someone is that you may absolutely be correct that this is the greatest company in the world and they got the greatest products in the world, but there's nothing that that you just said that the market doesn't already know. And what is price telling you it thinks about that?
Yeah, and one of the things that I heard you say is that the news follows price.
Correct.
So Apple's going up, and somebody releases some news article about like some great thing that Apple's doing, right? People don't release articles about the great thing Apple's doing when it's like crashing and tanking down, right?
It's all the bad stuff.
Yeah, and the analysts will do their post earnings report on everything they did that was great, right? And it's like, well, yeah, it's easy to see it now, but and then vice versa when the earnings are bad, all these bad news articles will be coming out. Oh, don't buy this, and the price always leads the action. The news always follows.
Yeah, and that's dangerously close to that idea that the fundamental story fundamental story almost always follows price action, right? So no one's telling great fundamental stories on stocks that are hitting new lows. They're only telling great fundamental stories on ones hitting new highs, right? So amazing how that works. That's how analysts get to look like a champ, right? Any of us can go find a stock or security trending higher and then say it's great for the. That was one of the things that's great about that Turtle Trader book where they talked about this guy that was bullish on sugar. And the guy that had wrote this book, I believe it was the guy that wrote it, was interviewing these turtle traders and interviewing this guy that had wrote this bullish article on sugar, and asked him about, where did you get this information? Why were you so bullish on it? And he said, I kind of just made it up. I just made up the story because sugar's price was going up. So here's the reasons why.
Yeah,
when it
he's
comes
rationalizing
Yeah,
backwards.
yeah.
Why is this going up? Oh, well, you look at all these, pieces of information that I didn't know.
Making the story fit the price action shoe. Now, when you talk about news is tricky. There are definitely times where good news makes something pop, and there's bad news that makes something drop. The problem is if you've been doing this long enough, you'll see how it almost never makes any sense, right? You'll see this horrible jobs report, but markets rally.
Yep.
You'll see this horrible jobs report and the markets sell off. You'll see this horrible earnings report. Typically what's happening there, and you can't make sense of it. You can't make sense of why did they hit it out of the park with their earnings. Why did the stock drop?
Yeah.
Or this was terrible. Why did it rally? That's where you start to see the news feed, as I say, follows price. What's funny, which is a great time, is when you see like a pre-market report come out. So whether it be a GDP or a jobs report or a CPI, and the market react favorably or something, right? And so you'll see all this. Everybody wants to be the first, right, to get the clicks. And so all these reasons why CPI was great. And then give it 15 minutes, 20 minutes, and oops, markets reverse, right? Start to go down. And then pretty soon you can't find those articles anymore. And now it's all these reasons why the exact same report was bearish.
Interesting.
So I watch that happen all the time, and I just laugh. And sometimes if I'm fast enough, to get these things, I'll show everybody, look, this is the article that came out at 8:35 when the market rallied. Look at 9:05 when the market sold back off. It's amazing how it was bullish when price was up, right? The fundamentals were bullish on that report. But now that we're down, oops, these are all the reasons I told you. Like, well, you didn't tell me that 37 minutes ago, but yeah.
Yeah, so your advice to people who would be picking stocks would be just avoid the news.
Exactly. Well, going back to those turtle traders, that's what they were required to do because
So they were locked in a room.
They were locked in a room. They weren't allowed to plug in. Now, keep in mind, back then we didn't have what we have now, but they weren't allowed to let those things affect their trading decisions because they can make you emotional. Like these news, these pops and drops, these fundamental stories, these analysts coming on, and then of course there are things like. All joking aside, like I remember when Obama was president and Boehner, and there was that big, nasty debt ceiling clash. And CNBC had this countdown to debt ceiling just going off in the corner all the time. Like, well, it's no wonder nobody can make any money because that makes me think, is my house going to blow up? What's getting ready to happen when this thing goes to zero, right?
Funny how things haven't changed. We just did that, 3 months ago?
Yeah. So I always tell everybody, look, one of the first pieces of advice I'll give you if you want to succeed trading and investing is turn the TV off. Don't read. You can do your analysis yourself. It's not that hard to do much sounder analysis than where you're going to get there. But if you want to succeed, it's all about controlling emotion. And if you let every clown out there with a suit sway you one way or another, or cheesy little graphics like this thing's, the market's going to blow up this week because of GDP reports, it's going to make you make emotional decisions. An example I always like to give was way back, speaking of Obamacare. Okay, when that was obviously a real contentious debate going on round about that. And I remember going into that weekend, how the consensus was that if this passed and the vote was going to be on a Sunday, that markets were going to tank. Like markets are going to just go absolutely, they're going to drop 5-10%. Same thing if you think about when Trump was elected. The consensus was, oh my gosh, everybody from
panic.
Yeah. Now, granted, when it was clear Trump won overnight, markets did drop about 5%. But by the time they opened, they were barely down and they ended up rallying, right? This consensus, but it makes you emotional, right? Oh, I better go short everything because if Trump wins, right? Well, when Obamacare got passed, it was the same idea. And here was what was funny about it. Not only was the market flat on that Monday when Obamacare passed, healthcare stocks, which were supposedly going to get killed by this thing, right? Oh my gosh, we're actually up that day, right? And so my point isn't necessarily that we can figure that out. My point is that you just don't know how markets are going to react. There are things that are discounted in advance. There are things that buy on the rumor, sell on the news. Those things make you emotional. It makes you make bad trading and investing decisions, which is why I always say, turn the TV off. Don't listen to any of these guys in suits and ties. If you really want to get an edge, technical analysis is where it comes in. Look for breakdowns. Look for reversals. Get yourself a good risk-reward setup. Right position size. That's how you'll beat the market. You won't beat the market by making every call right? I mean, I think we're in VelociTrader, what are we, somewhere around 50 and 30 or 50 and 35, right? So we have more winners than losses, but I mean, we take a lot of losses too. We don't win that way. I have another service that I operate that is has like a 40% win rate, but it's the most successful service I operate. Because remember, it's that kind of raising of, think of that, what do you call that? What do you call on the cover of Injustice for All, Metallica? With the weight, what's that called?
Scales?
Scale. Thank you. Gosh,
I,
the simplest word.
I thought there had to be,
The
a more
simplest.
complex word.
Yeah, I was like, oh gosh, the simplest word, scale. But you think about,
You went straight to a Metallica
yeah.
cover to describe that? Jeez.
Well, that's what I think of.
Come
Like
on, Steve. Where were you?
she's holding this scale, right? So pull it up. Pull up, Injustice for All. You'll see what I'm talking about on the cover. But he's really pulling it up. But the idea is that when you look at, see,
Yeah.
that
Be cool, man. Get that one tatted.
Yeah. So, but the idea is, so when you think about high win rate, how you get high win rate is you're risking more to make less.
Yeah.
Lower win rate, the reason why, and that's that false perception that the public has, like that a high win rate matters. Win rates aren't really too terribly pertinent. You need to know, well, what are they doing? Are they so lower win rate? A lot of times your traders that are making the most money are the ones with a sub 50-50 win rate because they're risking very little to make a lot. So that's a lower probability trade. You're not going to be right as often, but when you hit it, you're talking to 1,000% winners, right? So.
Yeah, and I want to break here in a second, but Steve, can you pull this up? It was this is like the classic example of that win rate or that win percentage. It was the guy who bet like 1.2 million on
Yes.
the Chargers. Just search
Yeah.
like guy bets 1.2 million on Chargers.
Now, do you have any idea how many messages and emails I got on that?
I'm not sure, but yeah. All right, so here you go. Gambler loses massive $1.4 million bet on Chargers Jaguars game. So it says, keep scrolling here. After the Jags mounted an epic comeback to beat the Chargers 31-30, he wagered 1.4 million. The Chargers. The unlucky gambler would have only made a net profit of $11,200, 0.8% of the total wager if the Chargers won. It's unknown who originally placed the bet. So basically, he's risking $1.4 million to win $11,000, which winning $11,000 sounds good,
Yeah.
But
Yeah.
if you got $1.4 million, that is the exact opposite way of how you should be either A, gambling, or B, placing trades, right? And I think that this is a really helpful way for people to start thinking about things is that risk to reward ratio, right? Like, and this can be applied not just to trading, this can be applied to everything in your life. Like, I got a fast car, like I bet I can get it to 140 miles an hour. It's like, okay, well, what am I risking? Well, I'm risking my life and also getting arrested, a $3,000 fine, all this stuff. Okay, well, what's my reward? My reward is like a thrill. And I'm not saying don't like go drive your car fast. I'm not saying don't physically engage in things that are dangerous. But when you start to place it through like that lens of like, I was just in Mexico and we were walking home and we had some beers that we hadn't opened yet. And it's like, should we open these beers? And the reward is like, I get to drink this beer like 10 minutes quicker than getting back to my house. But the risk is like the Mexican police stop us and take us to Mexican jail for 36 hours.
Yeah.
So when you stop and think about it like that, you're like, oh, this risk to reward ratio is
not
like
great.
really, really bad, And that I think has been one of the most helpful things, even in business, like risk to reward, again, you can start to think about it. And unfortunately, this is why certain, marketing tactics are out there like robocalls and things, because the risk on a robocall is like zero. They pick up the phone, they go, F you, and they hang up, right? But
Right.
the reward, if you get one client off of that, is, 10,000x the cost of actually placing that call. So, when you start to think about these risk reward spreads a little bit more, I think that it just helps you make more clarity in your decision making across all things in life.
Well, absolutely. I mean, without a doubt, especially when I'm working with students that might be just starting out or in the beginning stages of their trading, there can be this perception of like, I can't do it. The overwhelming, how do I learn all this? Oh my gosh, there's so many factors, yada, yada, yada. What I try to get them to understand right out of the gate is there's only one thing that truly, really matters. You do not need to learn 99% of the stuff that you've been duped into thinking you do. Okay, there are thousands of traders on this planet that are trading just good old-fashioned price, and they're doing it on one computer, all right? So don't buy into that nonsense. The thing that you need to learn to respect, value, and use to your advantage, the only real tool you have to beat the market in reality is your risk reward setup. Okay. Everybody focuses on everything else. Everything focuses on, again, like we talked about earlier, how many monitors do I need? One, your phone. Okay, but what a software program? Who cares? Okay, but which indicators? Who cares? Right? Indicators, price, whatever. It's just a setup. Okay, it has nothing to do with whether or not you're going to succeed, and that's that fallacy. We believe there's this magic set of indicators or this magical strategy. I'm telling everybody right now, it doesn't exist, never has, never will. Successful traders, forgetting about investors, successful traders succeed not because of any of that nonsense that you see Twitter guys put out there and your YouTube and the pop-up ads and all that kind of nonsense. You succeed because of the boring stuff, right? A setup's a setup's a setup, I like to say. If you want to succeed, first off, don't blow up your account by putting all your money into one option trade, okay? The most undervalued aspect in options trading is position size. You are not going to be able to control emotion if you have a $5,000 account and you put all of it into your Tesla puts, right? On top of that, maybe you did have a good risk reward setup in that trade where maybe you could make 200%. Are you really going to let that run 200% knowing that if it goes the wrong way, you get wiped out? No, right? So one of the students that joined the same program you did, I met him for less than 2 minutes when he came into the Chartist Academy, and I knew right away what he was doing. And I pointed it out. I was doing one of my presentations up on that big screen that I have, and he came. It was like 10 people, and he had to leave early. And I was saying something, and I looked over at him when he was going to leave. He was waiting to finish to say goodbye. And I looked at him and I said, and that's how I can tell that's exactly what you're doing wrong. And he dropped his head and just smiled. He's like, he's right. And I only talked to him for 2 minutes. And I was like, well, you told me. He's like, how'd you know? I'm like, well, if at this time, keep in mind, Tesla was like a $2,000 stock, or this was before the split. And I said, dude, if you're putting $10 into your options premiums and you're buying 10 contracts, okay, and you're telling me about your short time durations, there's no way you're letting that thing run as far because you're going to get emotional. You're blowing up. So position size and then risk and reward. If you risk a little to make a lot, risk 1 to make 3, 1 to make 5, 1 to make 2, you're using math to your advantage. That's how you beat the market. Knowing that, well, if I'm wrong, if I'm risking 1 to make 5 in my trades, I only need to be right 1 out of 6 times. 17% win rate, I'm breaking even. 30%, I'm crushing it. Mm-hmm. So let's be clear, 70% loss rate and you're crushing it. That's your secret weapon, right? You might have a month where you break even, right? But you couldn't really possibly have a month where you're wrong more than 83% of the time. And even if you could, you can't do that in back-to-back. And all you need is, right, a 30, 40% month the next month, right? And then all it takes is that 1 month, where you crushed it. You were right 70, 80% of the time, and you just made your whole year. And that brings me back to the turtle traders in the back of the book when I did that presentation in Vegas. It was a big audience for another company, and they asked me to do it. And I was trying to demonstrate a similar point. And I came trotting out there in sweatpants and like a muscle shirt. And when I came out, the guys that put the event on, first off, like, what is he doing?
Yeah.
And the point I was trying to make, I'm not going to go through the whole spiel that I went through, was like, I wanted you to see the reality of trading. Okay, us trading at home, doing our thing. Notice how I've got my sleeves kind of rolled up here. I got my sweats on. I'm working, man. I'm not sitting here with all these screens and my aviator glasses on and the Ferrari in the driveway type of thing. It's work and it's hard. And the reality is we're not sitting in suits and ties either. But then I went on to talk about the turtle traders, and I brought up one trader in particular, their track record. Now, keeping in mind they were trading stocks. The reason I wanted to show it was because that particular trader had lost money 9 out of 12 months of the year. They only made money in 3 months. And that was how it went with most of these traders, where they were wrong way more often than they were right. That trader made 110% on their portfolio that year.
Whoa.
For Richard Dennis, right? So the point was, because when they were right in those 3 months, it was so big, but they kept their losses small enough in those 9 months that they walked away. And let's be clear, that's 110% return with stocks, not options.
Wow.
Right? So everything is about risk reward, and that is your secret weapon in trading.
Love it, man. Let's take a quick break.
Deal.
All right, Christian. So we've talked a lot about options and trading, and certainly trading's not for everybody, right? Like it's probably not for most people, as
Mhm.
you stated early on. Like a lot of people should just let a financial advisor take their money and put it into reasonably safe long-term funds. Um, but maybe in totality, talk to me about how you would encourage people to think about money, finance, risk to reward, and how to kind of take control of their financial livelihood.
Sure. Yeah, absolutely. Big question. As it pertains to the market, you know, I do think that first and foremost, right? I mean, what is real estate in the market, right? If you want to put yourself in a desired position when you're get later down the road, these are the vehicles. I don't know that business is for everybody,
Yeah.
but certainly someone could invest in real estate, as you mentioned, create a real estate portfolio, money in the market for whatever duration fits your parameters. So of course, I think I like most would encourage those types of things. I don't know that anyone wants to wake up 60, 70 years old and have nothing. So but when you really drill it down to the market, and when I get asked about how I want to be in the market, how should I do that? What's the best way? You and I kind of covered it. I'm like, look, if you don't have the stones for it, if it's just not for you, then that's what financial advisors are for. Let them do their job, you know. But if you're going to be in the market, do I think you can do better? Well, I know you can, but you have to ask yourself. You need to be honest, right? It's not a casino. It's not a get rich quick. Um, when you talked about when we talk about the rise of Bitcoin up to 60,000 and such, I remember reading an article, something along the lines of all the money that was made in Bitcoin, it was made by like 1% of the people. Okay, no different than day traders, no different than the meme stocks, right? You have to be realistic about get rich quick, so forth and so on. And it's just not how it is. Anybody can have a good trade. Anybody can have a good stretch. I did when I first started, and I got wiped out over the next month and a half. Anybody can do that. But if you really want to be in the market long term and you'd like to do something, you like to do that yourself, I would say, one, make sure it's money you can afford to lose. You know, one of the top ways to control emotion is don't be emotionally attached to that money. If that money has to go to the rent next month or the mortgage, you're going to be emotionally attached to it. So make sure if you start out, if you want to get in the market, I want to start building something up here. I want to learn a little bit. There's nothing wrong with that. Start with your 1,000, start with your 5,000, and just make sure it's money that you can afford to lose. So when you talk about that aspect of it, and bigger, well, what if I have more? What if I do have 100,000? As you and I've discussed, I always say the more the merrier. The more capital you have to put in the market, believe it or not, the easier it gets. Very difficult to have $1,000 portfolio account and not be tempted, right, to put $500, because it feels like with one contract or something at $50 each, it's like I'm never going to get anywhere. And then that's where you ultimately run into bad position size, right? But if you have 100 grand, you have 150, 200, it is not too terribly difficult to make headway without taking on a lot of risk, right?
0.5% per week,
There you
probably
go.
third of
Not
a percent per week.
not too hard to make $500 that week. It's not too hard to make $1,000 that week. A nice little 1% gain. Doesn't sound like a lot, but extrapolate that across the entire year and look where you are.
Well, 1% per week is over 26%, annualized return, which is a lot. I mean, the market, I'm doing air quotes, is what, 6-7% per year, something like that.
Yep. So, and that's not hard to do. And so, if anyone out there is thinking that you can't, you can. But I think you have to be honest with yourself and the position you're in, and so forth and so on. If you are not, as I mentioned to you earlier, the thing that I get paid for is, when it comes to running my trade services, is the fact that I look at trades non-emotional. Especially for my members, I'm like, we did this and we stick to our guns. If you don't feel like you have that, then just be honest and just don't bother with it. But I do think that if you have capital sitting around that you can put in, I think it's worth giving it a go. I think that with a little bit of education, with a little bit of money management, right? As we said a couple times already, don't put that entire 5 grand into one trade. $500 trades, $100 trades. You can learn a lot. You don't get wiped out, and it can actually be kind of fun. It is not fun to wake up that next day and find out you just lost your 5 grand. So
And last thing, it's September 14th, 2023. What's the sentiment of the market like for you right now? What are you seeing in the market?
When it comes to the market, there's always those times where you have a certain degree of confidence in up, a certain degree of confidence in down. Sometimes you just don't know. So if we're talking about breaking into different time scales, obviously we had a pretty good little bear market last year. The debate is raging. Are we still in it? I think.
Are we in a technical recession?
Yeah.
That was the whole thing with the White House. It's not a technical recession,
Technically,
right?
technically,
right.
Every indicator on the planet that I can find that has been meaningfully reliable or 100% reliable over the last 50 to 70 years says that we are either staring right smack dab in the face of a recession or we might actually already be in it.
Mm.
And so the problem I have with that is if we say, okay, I trust those indicators because they've been not only very reliable, but some 100%. I think when you look at the inverted yield curve, for example, or you look at imports, these are things that I think have had a 100% accuracy rate in the last 70 years. So the problem is, how do you say we're in a bull market that's going to continue to go to new all-time highs, not just 52 highs, while also saying you think we're going to go through a recession? So, and it's not impossible, but are you saying that I think we're going to go into a recession and we're just going to ignore it? Okay, maybe.
You mean the market?
Yeah. Historically, I don't know if the odds favor that outcome. But we've rallied from 3,500 to 4,600 on the S&P. Well, if you look back in the Great Depression, you look at some of those rallies. If you look at 2001, you look at those rallies. If you look at 2021, if I remember correctly, S&P was goofing off around 2,100, if I remember correctly. Maybe it was 2,200, somewhere around there. Dropped something around 10%, 12%, something like that. Rallied, got back 98% of it, I think. 95, 98%. But never hit a new high. It was still in a correction. So the problem is I can't say that just because we retraced 80% or whatever it is of last year's bear market that it's over, unfortunately. So when you look at that big picture, I'm kind of torn. As I tell everyone, look, if we ran to all-time highs, 0% surprised. If you asked me to say which one would surprise me more, I still think people should not be surprised if we're hitting new lows in the next 6, 9, 12 months over last year's lows. Now, if we narrow it into a closer scale, where are we at in the intermediate? We started to pull back a month and a half ago. As you know, we forecasted that pretty quickly. Market was sending a message, hey, watch out, probably a 7 to 10%er. S&P fell 6%. I think the NASDAQ fell close to 10. So we may have already fulfilled it. We've been rallying over the past few weeks. Today looked pretty good. But the number that I'm watching right now is 35K on the Dow. To me, that's the best barometer of whether or not we're running to new 52-week highs.
The Dow Jones is 100 companies, is that right?
Dow 30. Yes. And so it's not my favorite barometer, but what I do is I bounce around from Dow, S&P, NASDAQ, not usually the Russell. I think the Russell is a very good barometer of economic health because of the small caps.
Yep.
And it can tell us a lot about risk on versus risk off. No different than junk bonds, right, versus T-bills or whatever. If everybody's piling into junk bonds, it tends to show an appetite for risk. And that's a good thing. It's bullish, right? If everybody's piling into small caps, the smaller companies, the more speculative stuff, that means they're kind of probably really bullish. Same thing with tech, because that's where you're going to get the bigger gains. It's hard to get the bigger gains with some of the blue chips like a GM or a Ford or
Home Depot.
Yeah, Walmart. They just don't move a whole lot, right? The real frisky guys are the ones that can't. But I like to bounce around and try to find what's going to give me the best indicator of up or down. Down is a little tough for me right here. I'd say 15,275 on the NASDAQ 100. If that fails to hold, that would be a sign to me that we're probably going back down to those lows from a few weeks ago. But if you look today, the Dow was knocking on the door of that 35,000. I think it made it to 34,9, I don't know what it was, 77 or something like that. So just like within a tick or two. And so if the Dow takes out that 35,000, so if you're watching the market, if you're in the market, you see the Dow close and hold above 35,000 tomorrow or next week or whatever, I'd say that's probably a pretty good sign that that little mini, it's not really a technical correction, but that nice little pullback we just had is probably over. We're probably rallying into the end of the year. Seasonally, October, November, December are the three best, the best quarter of the year.
You got it there on the right hand side. There's the S&P or the SPY right there.
Yeah. Well, if you pull up the Dow, click
It's
the
the third
Dow.
one down. Yep.
Yeah. Was I right? 34,977 was the high.
So if you just click that one, Steve.
And move your cursor on over there to that last bar.
Yeah, that's just.
Oh, it's a 1-day chart.
Yep.
You want to hit that 1 year down there? See if it switches to it or.
And for those just listening, we have the Dow Jones chart pulled up, and
go to that last green one, and I think the high today was somewhere around there. Boom.
977. Sure enough. Yeah. So I mean, plus we are in the third year of the president's term, which is always historically a good year.
Yep.
Correct.
Yes, it is, and it has been.
And then next year is probably going to be pretty volatile. You'd have to imagine, depending on what happens in that presidential election.
Well, that's what I can see happening here is that I can see that, all right, seasonally, which doesn't always hold, but commonly does. This year, seasonality, as you just mentioned, tends to point towards good years, and we've had one. Seasonally, August into September is not great. We've seen that. So far, we're sticking to that seasonality, which means if we continue to adhere to it, you get around beginning to middle of October, that's when the bullish bias tends to take over and takes us into the end of the year. So I could see a scenario here where either we're going to go up now and markets are saying we're not going to wait for October, or we roll back down, take another dip, and then start to rally. I could see a scenario where we rally, everything holds true, but we do not take out those highs from 2022. I guess it's 2022 if you're looking at the S&P, 2021 if you're looking at the NASDAQ. And then maybe next year's the rough year. Maybe that's the year the market starts looking at this recession type thing. Some believe we haven't beat inflation. Historic bouts of peak inflation come in multiple waves, and usually two. And you think you got it beat after wave one, and then here comes wave two. So
like being in the eye of the storm kind of thing.
So right now we're kind of in that eye and that it resurfaces. Some think, nope, deflation is going to solve this problem, and that's what you're seeing with some asset prices. So we'll see how that. I'm certainly not a economist or fundamental analyst, but obviously I follow it. So when you look at the market here, I think the bigger trend right now, I haven't seen anything technically that tells me this bull move is over or weakening or ending. However, we did see a lot of consistency at that peak at 4,600 on the S&P. There were a lot of signs that peak was a peak and that peak was coming. So could be, but the signals and signs that I saw weren't big in scale. They were more, look for a large pullback or correction. They weren't like what we saw when we were able to predict the bear market. That was big scale. You and I have looked at that was monthly type scale where if it is correct, it implies a large scale outcome. So we got that with the 35% bear market. What we saw back there in August or July or whatever with the S&P peaking, same type of signals, but on a smaller scale. So it was like daily. But big moves start small. So we'll see where it goes. Right now, I'm going to go with what's been working. We're in this bull market. We're pulling back like we should during this time of year. Odds seem to favor that we rally into the end of the year. So whether or not that low is in from a few weeks ago or not, odds right now seem to point towards more upside one way or another as we close out the year.
Christian, man, where can people find you and learn a little bit more about you? And if they want, find some coaching.
Yeah, for sure. Obviously, thechartistacademy.com, right? That's my main website. Now, I do have a free Facebook group, a community, just Chartist Academy, where people can come in, get to know me. They can join. I do free webinars, live trading, coaching, provide some educational content and such. And then, I always prefer everybody to get to know me, just kind of get a feel for what I do and how I do it. And then if you want to have a conversation about working together, got a pretty in-depth coaching program. It's a lifetime coaching program. So I work with people for life, right? They're not on the clock. But first step, take a look at the site. More importantly, I'd say come into our Facebook group because you can get on these calls. You can hear, and when I'm, pulling up charts, and you can see the logic and you can see things panning out. You can ask questions and a lot of free education. So I think those would be the two ways I would say, hey, come check us out.
Christian, man, thank you so much. I appreciate you. And thank you for all the information.
You bet, Alex. It's been great working with you, and I appreciate you inviting me on.
Thanks, man.